Welcome back to the Deep Dive. We're the podcast where we crack open stacks of information to give you the most crucial insights. The idea is you feel instantly well-informed, without all the overwhelm. Today we are doing a deep dive into Corning Incorporated's latest earnings call. That's Q2 2025 and their news release. You gave us these sources, and our mission, as always, is to pull out the most important nuggets, maybe some surprising facts, that really help you understand what truly matters in their recent performance and what they see coming down the line. Okay, let's get into it. So right off the bat, the headlines alone are pretty attention-grabbing. They're talking an outstanding second quarter. Record sales and record earnings per share, EPS, both blew past expectations. If you look year over year, core sales jumped up 12% to $4.05 billion, and core EPS, even faster growth, up 28% to $0.60, and it doesn't stop there. Operating margin expanded significantly, hitting 19%, plus adjusted free cash flow is up 28% too at $451 million. When you look at those numbers together, it just screams strong momentum, doesn't it?
It absolutely does. Yeah, the numbers are impressive on their own, but what's really fascinating, I think, is how these results tie directly into their big strategic plan. They call it Springboard. Now, they launched this back in the fourth quarter of 2023, and it had some really ambitious goals. Boost sales dramatically, improve the return profile, and hit a 20% operating margin by 2026.
Okay, so they set the bar high. How are they doing against that?
Well, that's the thing. They're at the halfway point now, and the progress is frankly remarkable. Sales are up 24% since the plan started. That's added over $3 billion to their annualized run rate.
Wow.
Yeah, and operating margin. It's expanded by 270 basis points, so up to 19% now, getting close to that 20% goal. And EPS has grown, get this, 54%. That's more than twice the rate of sales growth. It really shows they're, fundamentally changing the business structure, not just chasing short-term wins. They even felt confident enough back in March to upgrade their internal plans by $1 billion.
$1 billion. Okay, so they're feeling good about the momentum.
Exactly. It shows real confidence. And looking ahead, just to Q3, they expect to add another $600 million to that annualized sales run rate.
Okay, so if that's the kind of momentum, and it's tied to this Springboard plan, what's actually driving it? The sources seem to point to two huge forces, Gen AI, generative AI, and this renewed push for U.S.-made solar. Let's maybe start with Gen AI. It feels like that's everywhere right now.
It really is touching everything. And for Corning, it's huge. In their enterprise business, that's the stuff inside the data center.
Yeah.
They saw phenomenal growth, 81% year-over-year sales growth in Q2.
81%, just from enterprise.
Just from enterprise, yeah. The main technical driver is something the industry calls scale out. Think of it like this. Hyperscale customers, your Amazons, Googles, Microsofts, they're just connecting more and more AI processing units, or nodes, within their existing GPU clusters. This builds bigger neural networks, and since every single AI node connects using fiber optics, well, demand for Corning's fiber just shoots up.
It's incredible, isn't it? The sheer amount of physical stuff needed for all this digital intelligence. So scale out is basically more connections, more fiber within the current setups. But I think I heard you mention something else. Scale up. What's that about? Is that different?
Ah, yes. Scale up. That's where it gets really, really interesting and potentially even bigger for Corning. Scale up means the hyperscalers are building much more capable individual AI nodes. So moving from maybe under 100 GPUs per node today to hundreds, potentially, in the future.
Okay, so fewer nodes, but much more powerful ones.
Exactly. And as these super powerful nodes get built across multiple server racks, the connection distances within the node get longer. And here's the kicker, the really surprising fact. A single modern AI node, something like NVIDIA's Blackwell, currently uses over 2 miles of copper wire inside it. For its 1,200 plus internal links...
Wait, hang on. 2 miles of copper inside one single processing unit.
That's right. 2 miles! It's astonishing.
Yeah.
And this is precisely where Corning comes in. As these nodes scale up and those internal distances stretch, you quickly hit what engineers call the electrical to optical frontier line.
The E to O frontier. Okay. What happens there?
It's basically the point where copper just can't keep up anymore. It's too slow, uses too much power, gets too hot. It's just inefficient for that kind of data speed over distance. So fiber optic connections become the only practical and economical way to do it. That 2 miles of copper we just talked about, it gets replaced by fiber. And as nodes get even more complex, those miles of fiber will only increase.
So the opportunity is swapping copper for fiber inside these new supernodes.
Exactly. And this scale-up opportunity alone, they estimate, could be 2 to 3 times the size of their entire current $2 billion enterprise business.
Wow. That's a huge potential.
It is, and they're not just waiting for it to happen, they're already deeply involved. They're partnering with key customers and companies like Broadcom and NVIDIA on something called co-packaged optics, or CPO.
CPO, co-packaged optics. What does that mean in simple terms?
It basically means integrating the fiber optic connections directly onto the silicon chips themselves. Putting the optics right next to the processor, this drastically cuts down latency, the delay, and massively increases bandwidth. It's key to making the scale-up future actually work.
That really paints a picture of how critical the physical layer is. It's not just software. And this AI impact, it's not just inside the data centers, right? It reaches out into the wider networks too.
That's absolutely right. Yeah, another really significant growth area tied to Gen AI is in their carrier business, specifically in something called Data Center Interconnect, or DCI.
DCI. So connecting different data centers together.
Precisely. It's the high-speed fiber backbone that links data centers, often across cities or big campuses. And what Corning is seeing is that most of the existing long-haul fiber routes are basically full. They're nearing maximum capacity. So there's this critical need for brand new, high-bandwidth, low-latency links between these data center hubs. It pretty much means a major rebuild and upgrade of these long-haul networks is necessary.
Okay, so the pipes are full, they need bigger pipes.
Essentially, yes. And customers need denser fiber optic cables that can pack more individual fibers into the existing underground ducts or conduits. And Corning, very cleverly, has applied some of the innovations they developed for inside the data center to solve this problem too.
That's smart, taking those lessons learned and applying them more broadly. I think I remember hearing about a big deal they did last year.
You probably did. Last year, they announced a major agreement with Lumen Technologies. They provided Lumen with a new fiber and cable system specifically designed for this Gen AI DCI need. It allows Lumen to fit anywhere from 2 to 4 times the amount of fiber into their existing conduits.
2 to 4 times. That's a massive increase in capacity without digging new trenches.
Exactly. And that deal alone was so significant, it reserved 10% of Corning's entire global fiber capacity for 2025 and 2026.
Wow.
Yeah. And they've now fully commercialized this product set. They have 3 industry-leading customers already adopting it. It's still early days, relatively speaking, but they expect this DCI business to scale up really fast. They're projecting it could be a $1 billion opportunity by the end of the decade.
$1 billion just from connecting data centers better.
Right. And the timing is good, too, because carriers are finally finishing drawing down the excess inventory they built up during the pandemic. So now they're actually starting to plan for significant fiber network expansions again.
Okay, so AI is a massive driver, both inside data centers and connecting them. But the sources also mentioned a big pushback into solar. That seems like a different direction. How are they approaching that? They called it low risk, high return, which sounds, well, optimistic for solar.
It does, but their strategy seems quite deliberate and de-risked. It's pretty compelling, actually. They didn't just jump in. They spent the time from 2020 to 2024 quietly building a foundation. During that time, they generated over $1 billion in cash from their solar platform.
They made money from it before this big push.
Yes, exactly. And they reinvested that cash into expanding manufacturing. Critically, they did this alongside funding from customers and government support, like grants or tax credits. And throughout that whole period, they maintained positive cash flow every single year.
Okay, so it wasn't some speculative bet. It was a calculated buildup.
Precisely. It was disciplined. They reactivated some idle assets they already had to meet the growing demand for U.S.-made solar polysilicon. And then they added the capability to turn that polysilicon into higher-value solar wafers, also made in the U.S. And here's a key piece for that low-risk angle. They already have customers committed to buy 100% of their polysilicon and wafer capacity for 2025.
100% booked for next year already.
And 80% booked for the next 5 years.
Okay, that certainly changes the risk profile. That's fantastic visibility.
It really is. It significantly de-risks the investment.
And how does government policy play into this? You mentioned U.S. made.
It's central to the strategy. Government policy is actively incentivizing U.S. manufacturing for solar components. Things like the Inflation Reduction Act. There's a real push for domestic content. Advanced manufacturing tax credits are still in place, and there are even new measures encouraging U.S. production.
So they're riding that policy wave.
Absolutely. And their targets are ambitious. They expect to triple their solar sales run rate by 2027. That would add about $1.6 billion in new annualized revenue. And the longer-term plan is to build this into a $2.5 billion revenue stream by 2028.
$2.5 billion from solar by 2028.
That's the goal. And their approach is integrated, much like their optical business. They make the raw material, polysilicon, then they turn it into wafers. And some of those wafers go into their own solar modules. But they're also selling the polysilicon and the wafers to competitors at each stage.
Ah, so they compete and supply at the same time.
Right. It ensures each part of their process has to be competitive on its own, while also letting them offer the whole integrated package. It's a smart hedge.
That's a fascinating model. Using that existing materials, science know-how for a totally different but booming market. And you mentioned something else, another layer to their U.S. manufacturing strategy, beyond just solar.
Yes, absolutely. There's another potential growth driver they expect might emerge more clearly in the coming months. It involves new and existing customers looking to leverage Corning's huge U.S. manufacturing footprint. I mean, they have 34 factories in the U.S.
Leveraging their factories how? For other products.
Potentially, yes, especially if trade policies continue to evolve or global supply chains keep shifting. Think about companies wanting more secure domestic supply chains for critical components. Corning could become a key partner there. It's still early days. They mentioned confidential negotiations are underway, but it represents another potentially very significant opportunity depending on how things play out politically and economically.
Okay, so we've got these huge growth engines, AI, both scale out and scale up, DCI, the big solar play, and maybe even broader U.S. manufacturing partnerships.
Yeah.
Let's connect this back to the financials. How are these trends showing up across their different business segments? And what about their guidance for Q3? You mentioned strong numbers, but were there any caveats or interesting details in that forecast?
Yeah, so for Q3, they're guiding for another strong quarter overall. Sales around $4.2 billion and EPS between $1.63 and $0.67. Again, expecting profit to grow faster than sales, which is key.
Okay. Any specific factors baked into that guidance?
Yes, a couple of interesting points. First, it includes about a penny or two impact from currently enacted tariffs. Similar to Q2, they explain that their long-standing strategy of manufacturing close to their customers acts as a kind of natural hedge here.
Makes sense. Build where you sell.
Right. They did note that some OEM customers, the companies making the final products, pulled forward some orders in Q2, especially in specialty materials and display, because they anticipated tariffs. But Corning says they've factored that pull forward into the Q3 guidance, so they expect things to normalize.
Okay, so they accounted for that already.
Exactly. The other factor in the Q3 guidance is about $0 or 2 to $0 or 3 cents of temporarily higher costs. These are related to ramping up production really quickly for those new Gen AI and U.S. solar products we talked about.
Ah, the cost of success, basically, getting those new lines running fast.
Pretty much. They see these as short-term investments, necessary costs to meet the strong demand, and they expect these extra costs to fade away as production smooths out, sales increase, and the new factories reach full utilization.
Okay, so those are sort of like growing pains expected to be temporary. That makes sense. What about the actual Q2 performance within the segments? Did we see that broad strength you mentioned earlier?
We definitely did. Optical Communications, as you might expect with the AI boom, was the star. Sales surged 41% year over year, reached $1.6 billion. And that was primarily led by that massive 81% growth in the AI products for the enterprise, the data center stuff.
81%. Still amazing.
It is. But the carrier business within optical was also strong, up 16% year over year, driven by those new Gen AI DCI products kicking in, and as we discussed, carriers starting to buy again after drawing down inventories. Net income for the whole optical segment jumped 73%.
Wow, so profitability keeping pace there too.
Yes, although they did mention some current supply tightness for the very newest products, just because demand is so strong and they're still ramping up. Those ramp-up costs are a factor too. But they've introduced new pricing, which should help margins, and they said net income margins are already improving.
Okay, so optical is clearly firing on all cylinders. What about the other parts of the business? Display, for instance.
Yeah.
TVs and monitors.
Display was solid, steady. Sales were $898 million, pretty much flat with Q1. They expect the overall TV market for the full year to be about the same size as 2024, maybe with screens getting about an inch bigger on average. So a stable market. The really key insight here, though, is their pricing power. They managed to push through double-digit price increases back in 2024, specifically to counteract the weaker Japanese yen and keep their U.S. dollar net income stable. That's impressive discipline.
Right, holding the line on profit even with currency headwinds.
Exactly. And they expect to be at the high end of their target net income range for display this year, somewhere between $900 and $950 million.
Okay, and specialty materials, that's Gorilla Glass and things like that.
That's the one. Sales there were up 9% year over year, mostly driven by continued adoption of their premium glass, like the latest Gorilla Glass versions on smartphones, and also some of that tariff-related pull-forward buying from OEMs we mentioned earlier.
Got it. How about automotive?
Automotive sales were actually down slightly, 4% year over year. They cited weaker car markets in Europe and North America.
Okay. Bit of a headwind there.
A bit, yeah. But interestingly, even with lower sales, the segment's net income still grew 11%. They pointed to really strong manufacturing performance, cost control, and they're focused on their more Corning strategy there, getting more of their content, like technical glass for dashboards and sensors, into each car. New emissions regulations and the trend towards more complex displays and sensors in cars should help drive that over time.
Okay, so even in a weaker market, they manage profitability well.
Yes. Then life sciences, that was pretty steady. Sales consistent with last year, net income up 6%. And finally, the Hemlock and Emerging Growth Businesses segment. This is where the solar business sits. Sales there were up 31% year over year, driven by more volume in both solar and semiconductor polysilicon.
Ah, so that's where we see the solar growth starting to really show up.
Exactly. And that's the segment aiming for that $2.5 billion solar revenue stream by 2028. Their new solar wafer facility is actually due to come online this quarter, Q3, and start shipping product later this year. So more growth to come there.
Okay, so when you put all these pieces together, the big growth drivers, the solid performance across most segments, managing costs, it really points to a company in a strong financial position, right?
Yeah.
Especially thinking about cash flow and how they're using their capital.
That's definitely a key takeaway from the call and the release. They are making really strong progress on generating free cash flow. $451 million just in Q2. They expect to generate a significant amount for the full year, while still investing about $1.3 billion in capital expenditures, building out that capacity for AI and solar.
So generating cash, even while investing heavily in growth.
Right. Their capital allocation strategy is very clear. Priority number one is investing in these internal organic growth opportunities driven by their own innovation. They believe that's what creates the most long-term value for shareholders. They also make a point of maintaining a strong balance sheet. It's very efficient. They actually have one of the longest average debt maturities in the entire S&P 500.
Really? So they locked in low rates for a long time.
Seems like it. They only have about $1.5 billion in debt coming due over the next 5 years, which gives them a lot of flexibility.
And what about returning cash to shareholders? Dividends, buybacks.
Their main vehicle for returning excess cash beyond the dividend is share buybacks. And they have a really impressive track record here. Over the last decade, they've repurchased 800 million shares.
800 million. How much is that relative to the company size?
It's close to a 50% reduction in their total outstanding shares. Half the company bought back.
Wow. That's huge.
It is, and they calculate that action alone has created something like $26 billion in value for the remaining shareholders based on current prices. And they're continuing that. They bought back another $100 million worth of shares already in 2025, and they explicitly said they expect to continue buying back shares in Q3.
Which signals strong confidence in their own stock price and future performance.
Exactly. It's a clear signal they believe their Springboard plan is working and the momentum is real.
This deep dive has really shown Corning as a company that seems to be hitting its stride. They're taking their deep knowledge, their core competency in material science, and just expertly leveraging it to ride these massive secular trends, AI, sustainable energy. We've seen really outstanding Q2 results, smashing expectations, incredible progress, it seems, on that Springboard plan, even upgrading their own targets. And these powerful growth drivers in Gen AI and U.S.-made solar just look set to propel them forward. Their ability to actually deliver on these really complex, high-tech innovations while also managing costs, keeping the balance sheet strong. It's pretty remarkable to see unfold. So as we wrap up this deep dive, maybe here's something to think about. How often do we really consider the underlying physical innovations, the specialized glass, the fiber optic cables, the advanced materials that are actually making possible these digital and sustainable revolutions that get all the headlines? It's, I think, a powerful reminder. While the cool apps, the AI models, the flashy software grabs our attention.
This fundamental breakthroughs in material science combined with smart strategic manufacturing that are laying the actual groundwork, the foundational layers for entirely new economies to even emerge. So what does this deep dive into Corning mean for your own understanding of how future technologies will truly come to life from the ground up, something to ponder perhaps as you continue your own deep dives? Thanks for joining us.